Good afternoon, everybody. My name is Patrick Moore. I want to thank you for taking a few minutes out of your day to, learn a little bit more about something that I consider fun, but it's the employee retention tax credit. That's going to be this month's topic. For those of you who are joining us for the first time, Schedule CE is just kind of my name for a monthly educational session where we take 15 minutes, maybe 20, depending on the topic, and just go through something that could benefit you and your business. Sometimes they're tax topics, sometimes they're protection topics, sometimes they're investment topics, but they're all designed for you, the business owner, to get a little bit of value out of your day. And I don't want to waste your time, right? So I'm not talking typically about ideas that'll save you three, four, even $500. I'm aiming to save 5, 10, 15,000 plus dollars on each idea. So, as I mentioned, today we're going to talk about the employee retention tax credit. Before we really get going, as far as some housekeeping goes, on the right-hand side of your screen, you should have a chat. You'll have a public chat where you can interact with other people on the call. You'll be able to do a Q&A, and then you will have a private chat if something pops up that is an individual question you just want to ask while we're on the call. In addition to that disclosure, this is something that I definitely want you all to remember, is that this is general information, okay? This is not something where I'm recommending that you go do this, but at the same time, it is something that I hope is valuable. And if there is some benefit to you, feel free to reach out or, go talk to your CPA and see if this works in this example. By the way, if you see me look over to the right, that's me monitoring the chat. I've got my screen over here, so I am, paying attention. As I mentioned before, Schedule CE, I typically try and subdivide topics into taxes, protection, and investments. And today we're going to talk about taxes. If you have anything, that you think is interesting to you, I'd love to hear about a topic that you would benefit from so that, it kind of does my work for me as far as what you're interested in moving forward. Because really, for the most part, everything we're going to talk about today are things that interest me. So a little bit about that. I've been doing this for, I think, about 6 or 7 years now, and I started my own firm at the end of 2018. I'm a certified financial planner, and I'm one of about 5,000 or so under the age of 30 in the US. And really early on, I realized that advisors really didn't talk about taxes too much with their clients. So I wanted to bridge that gap between a CPA and somebody's financial planner and try and thread the middle and really provide some good value that really goes over taxes in addition to your broader financial plan. So what we're going to talk about today with the ERC or ERTC is what it is, first and foremost, because this is something that I think has kind of been trumpeted far and wide. It's probably the most popular program out there right now as far as government programs, and that's got some good and bad to it, right? Because when something's popular, it means that it's effective, but it also means that there's probably people stretching the rules. And if you copy what they're doing, you might get in trouble. Okay, so moving forward, I want to go over this today. What is the employee retention tax credit and how much is it worth? How you qualify, and as I was kind of talking about just a minute ago, what you need to avoid, because unfortunately there's been a lot of, because it's such a popular program, there's been a lot of issues, and in my opinion, we'll call it aggressive behavior with regards to the credit. It'd be very easy to get kind of swept up in that, as you're reviewing and you kind of see that big number pop up in front of your face. So the first thing that I want to answer today is, why does the ERC exist? Okay, because that's where I always want to start when we're talking about a tax credit or any type of tax program. So the employee retention credit was added to the tax code as part of the response to COVID. Okay, where it gets a little tricky though is that the ERC has been amended, updated, and revised. I think the last count I saw was 8 times. Okay, so it's been updated 8 times in 2 years. But at the end of the day, it's designed to reward you as a business for persevering through adverse consequences and paying your employees. Okay. So the key to remember here is that if you had a tough run during COVID, that doesn't on its own qualify you for this credit. It's here to reward you for paying and retaining your employees throughout the last 2 years. Now, the good part is that it's also fully refundable and it's based off your payroll. So that's what it is in a nutshell. Now, where things get a little more exciting is how much the credit is, okay? In 2020, if you were eligible for the credit, you would be eligible for up to $5,000 per employee in 2020. Where things get even better is that's only for the whole year. But if you fast forward to 2021, you're eligible for up to $21,000 per employee in 2021. Okay, and it's the first 70% of payroll on the first $10,000 of wages per employee per quarter. So if you paid somebody $10,000 in quarter one of 2021 and you were eligible, you'd be eligible for a $7,000 credit, and you could potentially be eligible in quarter two and quarter three as well. So and just being eligible for one doesn't exclude you from another quarter or exclude you for the other year, right? This is all cumulative. So as long as you meet the criterias for kind of, being in distress, then you're going to qualify for this credit. Now, one thing that also came out when I was talking about how much the program has changed is that when the program first was incepted, it came in the same bill that the PPP came, or the Paycheck Protection Program came out, and you were unable to get the ERC and the PPP at the same time or even ever. So if you did the PPP, you couldn't do the ERC and vice versa. And everybody chose the PPP. However, one of those 8 changes since it was made you eligible for both programs. Okay. Now what happens is that you can't get the ERC on the same wages you claimed for the PPP. But let's say you got the PPP in 2020 and you still had business issues in 2021. You could have gotten the PPP in 2020 and then you can still get the ERC in 2021. So let's move forward to how you actually qualify, and then I'm going to pause for some questions at the end of this section because this is where things get a little tricky. There's 2 main methods for how you qualify for the ERC. The first is a decline in revenue. The second is a partial or full suspension of your business operations. So obviously those are pretty broad terms, especially the second one. So let's dig in for a minute. First things first, your revenue. The revenue decrease is based on your 2019 numbers. Okay, so I'm going to use nice round numbers here. Let's say you made $1 million in quarter one of 2019. Okay, so the rest of that year doesn't really matter what we're talking about right now. We're going to talk about quarter one, and you made $1 million. In 2020, if you had a 50% decline in revenue, you would qualify if your revenue was less than $500,000. So actually we do quarter two, 2020. That would mean if in quarter two, and we compare it to quarter one, you had a 50% reduction, you would qualify for the ERC credit. Now let's fast forward to 2021, because this is where the kind of the requirements get a little bit easier to qualify for. Obviously you would have missed a whole year, but if in 2021, against that same quarter in 2019, so let's say quarter two, 2019, you had made $1 million of revenue. In quarter two, 2021, that would only have to go down 20% to $800,000 for you to qualify for the ERC credit. And what that would mean is each quarter that you met that 20% decline, every dollar of those payrolls up to that first 10,000, the 70% up to the first 10,000 would qualify for the credit. Now, you can kind of see that, if your business has gone down that much, it makes sense that you're, in distress. It's pretty cut and dry. It's a calculation. It's just based on revenue. But that's the easiest, simplest way to qualify. And that's item number 1. However, there is that second way to qualify. And this is where things get a little bit more complicated. Okay. If you were partially or fully shut down by a state, local, or federal government order, you may also qualify. And the reason this is so big for most people is that you don't have to have the revenue decline to qualify as shut down. Okay? And specifically, the partial shutdown is where things get a little bit tricky. But I want to be very, very clear here. Okay? It has to be a government order. It can't be a recommendation. It can't be you doing it on your own. It can't be something where you really don't have an effect. It has to have been an order that affected your business operations. Okay. So a full shutdown is fairly straightforward. Let's say you were a nightclub in Los Angeles. California probably had you shut down for a really long time. That's straightforward. We're not really going to talk about that. A partial shutdown is where things get a little tricky. If you had supply chain disruptions, you may qualify. And what would happen there is, let's say your vendor is in California. Let's say I'm based in Georgia. Let's say you're in Georgia. If your vendor in California was shut down for a long time and you couldn't find a great replacement, then that affects your business. If you were unable to access certain equipment at a certain location, you may qualify. If you were unable to work with your vendors, like we just talked about, you may qualify. And here's where things get a little, more kind of specific to your business is if, let's say, you had a reduction in the services or the quality of the services you could provide to your customers. Let's say, your supply chain got disrupted and you had to replace a component with an inferior part. That may qualify too. So if you do all of that and you have decrease in your services, your hours, you can't do certain things for your clients, then that's going to be something where you may qualify for this credit. Now, I'll give two examples that I think are, not exactly tough to wrap your head around, just to illustrate kind of the points I'm making here, because you can't just have one of those things and have there be no effect on the business. Okay. It has to exist and it has to have an effect on the business. So let's say you own a Taco Bell. The government orders the shutdown of your dining room. Okay. But you can still do drive-through, you can still do Grubhub, you can still do DoorDash, whatever it may be. A Taco Bell, that's a substantial piece of their business, right? So that government order had a substantial alteration or suspension of the business operations. That's a significant impact on the operation of the business, even though their drive-through business may have gone up so much they didn't have a decline in revenue. Now, this would only last while the shutdowns are in order. So let's use 2021, for example. Let's say for Q1 and Q2 of 2021, California had the dining areas of Taco Bell shut down. Well, Q3, they reopened it. You wouldn't qualify from Q3 forward. So it really is limited to the time periods and the payrolls you paid during those time periods to actually qualify for that credit. So let's use another example here. Kroger's our big grocery store here in Atlanta. So let's say you own a Kroger, okay? You're an essential business, right? You can't shut down. But let's say because of health regulations, you had to shut down your salad bar. Well, some people may disagree with me, but I don't really think that the salad bar is an essential part of Kroger's operating model. Somebody may disagree. But that's going to be something where I don't really think that's a partial shutdown, okay? Because even though so you checked one box, there was a government order. It did affect your business, so you checked two boxes, but it wasn't really a substantial impact on that partial suspension, and it wasn't integral to your main business. So that's going to be something where you kind of have to answer all of those questions. And in this example, I really don't think that it's a major one. Now, let's say you've got multiple locations, and one of your locations is forced to shut down and the other ones aren't. Well, if that has a substantial impact on your business, that may qualify. So here's the key out of all of that. All right. It must have been a government order to shut down. It could have affected your supplier. It could have affected you. It could have affected your customers, right? But it has to have been a government order. Self-imposed, even though it may have been good for your employees and your business and bad for your business, that doesn't count, unfortunately. General orders do not count. And what I mean by that is like CDC guidance is that just say, hey, COVID's bad, try and be careful. That really doesn't count. So here's what to avoid. I've seen and heard of some people basically saying that because the CDC guidelines say that, you should limit contact and that you need to keep your employees safe under OSHA, it justifies you claiming this credit. Okay. And this is really one of the reasons why I wanted to do this presentation, was not only to inform people of a program that's out there, but kind of go over some of the things that I really want people to avoid, because CDC guidelines and OSHA guidelines, in the text of the bill, it says the order has to be specific to COVID, and it has to be in order. Guidelines are not orders. And generally, a lot of the CDC guidelines and OSHA guidelines, because OSHA is from like the 1970s, that predates COVID. So it really doesn't count. So it must be a direct order that affects the operations of your business due to COVID. Now, this is something I added in this morning. The bill going through Congress right now is actually one of two that directly affects this. So right now, they're going to increase IRS agents, and they're increasing funding. This program, you see stuff about the ERC everywhere, okay? There's people doing all sorts of crazy things to get this money. And something that's kind of slid under the radar with everything going on with the bill through Congress right now is President Biden also signed a bill to extend the statute of limitations on fraud to 10 years for COVID-related relief funds. So if you're going to claim this credit, have your argument be airtight, do it the right way, and it's going to be a hefty credit, right? Like, I don't want to scare you off of it. It's going to be hefty. But I guarantee you in the next few years, you're going to hear a lot more about ERC fraud, about PPP fraud, about idle fraud, anything that's from COVID. You just need to be very careful, because I would rather sleep well at night. Now, I do have a little bit of a bonus piece here, okay? This is something that's, I don't think, as well known, but I wanted to share. There is one other way to qualify for the ERC, and this is one that I really enjoy. If you started a new trade or business after February 15th, 2020, you are eligible for credits in 2021 without the suspension, without the reduction in revenue. You can be eligible. Now, what we need to do is we need to define trade or business, okay? Obviously, if you start your own business, that's straightforward. It's a new business. But the word trade is interesting, because when you have your own trade, what you can do is you can actually be an existing business owner. But if you started a new line of work, a new trade with separate books, with separate clients, with separate expenses, separate payroll, even though you already have a business, you may qualify for quarter 3 and quarter 4 of 2021. So this part's fairly complicated, but the business has to have started after February 15th, 2020. Could be any time, through 2021. You have to have average gross receipts under $1 million for the last 3 years, which most startup businesses will have. And if you were not otherwise eligible for the ERC, so you didn't have the revenue, you didn't have the suspension, you're eligible for up to $50,000 for each quarter, or $100,000 total. So that's the third kind of, hidden in their way that you can qualify for this, and you can still go back and do that for the end of last year. So with that being said, if you think you may qualify, there are a few questions I want to wrap up with and ask. This is what you should ask yourself to figure out if you think you may qualify. Did you have a revenue decrease? Were you shut down by a government order? Was your supply chain impacted by COVID-19? Were your vendors impacted? Could you access all of your necessary equipment? Were you able to serve customers the way you desired? And were your hours impacted? If any of those were affected due to a government order, you may have a chance to qualify. So let's see here. I'm going to pause for a second, kind of let all that sink in. I'm going to look over here in the chat for a moment, see if I have anything new that comes in. And I have a question here from Cecilia asking if dermatology, like a dermatology and aesthetics business in Texas would qualify without a gross receipt drop. So Cecilia, if any of those questions were a yes to you, and it was affected by a government order, it actually doesn't matter what type of business you were. It purely matters on what the outcome was. Okay. So if it was a startup, yes. If you had a partial suspension, I know you're saying here that it was an essential business, that definitely limits the possibilities there for you. But if, for example, for a certain amount of time, you couldn't see patients in a certain way, well, that definitely might qualify, right? Just having to put on a mask probably doesn't. But, let's say for, the dermatologist, like you had to shut down your, I don't know, I'm just using some examples here, but let's say there was like, some skincare or like a surgery center you had to shut down for a few months, and that had a substantial impact on your business. That could qualify. So let's see here. I'm gonna type an answer out to that question while I wait to see any other ones come in. Okay. So to wrap up, all I'd like to say is this is a very complicated topic, and this is meant to be purely educational. So if anyone would like to chat, or if anyone does have a question, I am happy to take 15 minutes and just answer any questions you may have at no cost or no obligation. There should be a link that'll pop out here. That should be an offer that popped up in the chat and across your screen. That you'll be able to schedule a 15-minute call with me, and we can kind of chat in more detail about what is needed. Okay, so I have another question that's come in here. So if you're not the startup, which documents do you need to keep for evidence? So this is a good question. So the ERC filing is based off your Form 941s, which have your wage reports to the federal government and the IRS, to document how much you paid in wages, how much you withheld in Social Security and Medicare, taxes, things like that. What you have to do is you have to go back and you have to amend those 941s to claim the credit. And you'll need things like the orders that show what you were affected by. So, I know Cecilia, Texas probably, wasn't as shut down as my example, California, right? But let's say, the Dallas area shut down that surgery center. I'm just going to keep using that as my example. Well, you would need a copy of the order with the dates on there. You would need your payroll files to support that. And if you did claim the PPP, you would also need evidence that shows, hey, I had the PPP for this amount of time, and now we're going to use the ERC for this amount of time. It's a little different depending on every circumstances, but those are going to be the broad strokes. And then all you do is you amend to that 941 and you claim your credit. I'll go ahead and answer that question in the chat as well, if any other ones come in. Which documents? Payroll files, government orders. All right, and then I have another question that's come in from Teresa here. So, Teresa, if your cash flow is impacted, that's not going to qualify for the gross receipts test. That's probably going to fall under more of the partial suspension test, and then it would just depend on what it was that affected your cash flow. For example, if you couldn't fulfill certain orders because of a government shutdown order affected for one of your suppliers, maybe one of your customers was shut down and they couldn't do anything and it was due to a government order and that had an effect on you, then that may qualify. But it's not going to qualify under the financial test of the revenue. Let me go back just a second. Oh. But, if it was the supply chain, the vendors, if some of your equipment was shut down and maybe it caused you to miss orders, then there's a chance that you could qualify. So it kind of depends more on what the action was that caused that disruption to cash flow, rather than the cash flow disruption itself. Okay, and does anybody else have any other questions? Okay, it doesn't look like it. So what I'm going to do is I'm going to go ahead and wrap this call up today. There will be a recording. I'll probably cut out that area in the middle there when I was kind of paused for a moment, but I'll record everything. I'll also send out some guides, some handouts on things to avoid, things that could help you qualify, and kind of some general questions and things to ask, as well as maybe like a questionnaire to help you really hone in your thoughts and focus. But if you have any other questions, it says the calendar is currently unavailable. Let's see here. Let me see if I can get this fixed. Oh, that's strange. Thanks for letting me know, Cecilia. What I'll do is I'll get that fixed, and I'll send you the calendar link here in just a few minutes. So sorry about that, because that's a new one to me. All right. Well, I'm going to go ahead and stop the recording. If anybody has any other questions, please let me know. You should have my email out there, and we can dig in a little bit further and see if you do qualify. Have a good rest of the day.